Hey everybody, today's video or recording is not meant for my usual audience. I've been asked recently to explain what the difference between a classic venture capital fund is and a venture capital fund of funds, which is investing in other VC funds, and how the moving parts work. And I think some people have even just wanted to make sure they were fully clear on how this is different from a hedge fund or investing in the stock market even. So for investors that are new to investing in VC funds and fund of funds. So I'm going to explain how 7VC venture capitalist funds work and also benchmark that to our understanding of what are kind of classic, the most common terms of how these are set up. So I made another video that explains how VC funds work, which typically have a 2% management fee times 10 years. So 20% of all the investor dollars invested in the fund end up going to management fee. And then 80% of the capital raised in the fund is used to buy stock and invest in startups. And then we return money from that classic fund to the LP, limited partner investors, from selling of shares via an IPO on the open stock exchange after the company's gone public and it's now listed, publicly traded, or from M&A, mergers and acquisition transactions, where someone buys a stock and pays us that way, or from secondary transactions where we sell the stock to a secondary buyer, we get the cash, and we pay it immediately to our LPs. So what is a venture capital fund of funds? Fund of funds, or FoF, is where we raise money, again, from limited partner investors, and we might have many LPs in the fund. Some might be very large institutions investing 100 million or 50 million or 25 million, and some might be more small retail-esque accredited investors that are investing $200,000 over maybe a 2-year period of capital calls. So how does the money come into the fund of funds? What do we do with it? And how does the investor get their money back? And how do we pay you back? That's what we're going to focus on. So the purpose of a fund of funds, FoF, is to invest into different VC funds. For an individual, if you only have $200,000, it may not be practical for you to go out and try to meet with 10,000 different VC funds and negotiate investing into 1 or 20 or 30 of them. And if you only have $200,000, they might not accept anybody into their fund who's writing a check that's less than 5 million. So that means you might have no access to the asset class whatsoever. It used to be that companies like OpenAI would go public once they hit a certain amount of revenue, but we're living in what is often referred to as a stay private forever world, where companies no longer go public when they have 200 million of revenue. Many of these companies have billions and billions of dollars of revenue, and yet they're still privately held. So private markets is challenging for a lot of investors to access. Other large investors, like a sovereign wealth fund of Saudi Arabia or Singapore or the province of Quebec, might have so much money that they can't make small investments into smaller VC funds, and they can only write humongous checks. So it makes sense for them to write a check for 250 million to a fund of funds like ours, and then we parse out small 1 million, 20 million, $30 million checks into a basket portfolio of many high-performing VCs. And we'll talk later about how smaller VCs outperform the bigger VCs, and that's just math, and it's just factual with empirical data. It's how it's proven out. But for now, how does the fund of funds work for management fees and carry and things like that? So in the beginning, many, many years ago, like 20, 30 years ago, when we saw the first fund of funds emerge, they charged a 2% management fee annually across 10 years. And so that would be 20% of paid in capital was management fee, 80% went into the VC funds, and then the VCs are charging a 2% management fee times 10 years and 20%. So you kind of had this painful layer of fees on top of a layer of fees. And then the big investors that were investing in the fund of funds says, look, I appreciate it's a lot of work for you to meet so many VC funds and decide which ones have the best performance and which are the best ones to be investing in, get us a little bit of AI, a little bit of healthcare, a little bit of this, but we don't like this layer of fees on top of it. So there was pressure on the FoF, fund of funds, to lower fees. So typically we've seen that pressure result in most fund of funds charge a 1% annual management fee across 10 years. And instead of getting 20% carry or 20% of the profit, the fund of funds is only getting 10% carry. So instead of it being 20% management fee and 20% carry, or 2 and 20 on top of another 2 and 20 VC fund, it's 1 in 10 on top of 2 and 20, where 1 at the FoF layer means 1% annual management fee times 10 years. And that means 10% of the FoF, if it were 100 million, would be management fee to pay for the accountants and the software and the salaries and all the work. And then 90 million gets invested into the funds. So the dry powder as a percentage is higher. It's like 90 compared to 80 at the VC layer. And then if you invest in, say, 20 or 40 VCs, you now have thousands of startups underneath all those VCs. So imagine if each VC fund is investing in 15 to 50 different startups, and some of these might even have 250 startups because they're investing early. Or maybe it's only 25 and they're investing in a bit more of a concentrated strategy. Net, if you invest as an LP into a fund of funds, and we invest that into 20 or 40 different VC funds, there's going to be thousands of startups that are ultimately invested in with this capital. FoF goes to the VC goes into the startup. When these startups have exits and are paying cash back to their VC funds from IPO, M&A, or secondaries, those VCs typically, without any delay, some might recycle, but let's not worry about that. They typically are wiring that cash from the exit immediately to our FoF, and our FoF wires that money immediately to our LPs without taking any percentage out. So with an FoF, if we raise 100 million and we have a 1% management fee times 10 years, we invest 90 million. And the first 100 million without any fees is wired immediately back to the LP. And instead of the LP having all their eggs in one basket with just 1 or 5 different funds, and so maybe they're hitting like 25 companies per 25 different startups per VC fund. So they're in like 100 or 125 startups. The distribution should be much steadier if you're in 5 funds than if you were in 1 fund. If you're in 30, 40 funds, it's almost expected to be quarterly distributions with lots of different payments that are coming back to you. Now with our fund, we've made a tiered system for very large LPs. We're actually charging a 1% management fee times 5 years. So compared to 20% of the paid-in capital going to management fee with a typical VC fund, only 5% is management fee and 95% is dry powder. And when investors are wiring a check for 25, 50, 100 million or more, anything above 10 million, we're saying 1% management fee times 5 years. For LPs that invest between 1 million and 10 million, we're saying that we're going to charge a 1% management fee times 10 years. And to our understanding, that is industry standard, 1% management fee times 10 years. But because most of the capital we're raising is from larger LPs that are investing over 10 or even 25, 50, 100 million, the effective amount of dry powder in the fund is much more than 90%, which is a good thing for all LPs. We believe it takes a village to raise a startup, and the more network, the better, and the more value-added people that can open doors or help raise money or identify a fund to invest in, identify a startup to invest in, identify someone to buy the company and help with the exit. There's a lot of things involved, and the bigger the network that are all aligned, the better. So we allow for as small as 200K LPs to come into our fund. I'm not soliciting to investors. I'm just explaining how this works. So if somebody invests 200K into our fund of funds, they typically are paying $25,000 at the end of every quarter over 8 quarters. So they paid 25K March 31st, 25K June 30th. After a year, they've wired 100K in, and after 2 years, they've wired 200,000 in. So that's how the money is coming in. If they're getting in the very end of the vintage and we just met them, they might pay the 200K in one go up front. We then are wiring this money in our capital calls to 20 to 40 VC funds that the FoF fund of funds is funding. Then we have a direct strategy which turns around and offers to buy shares from the VCs that we've invested in, buying 10% to 50% of the shares they own in the startups that have gone up the most in valuation. So a VC that we fund might have invested in the next Facebook and it's gone up 100x in valuation, but they're still waiting for the IPO, still waiting for the M&A. They might want to return cash to their LPs to get them motivated to re-up in the next vintage. If they raise a new fund every 2 or 3 years and they've not distributed any cash, it might be difficult to get existing investors to even find the liquid cash to invest in their next fund. Whereas if you pay the investor their full 10 million back, they might be much more likely to invest 10 million in the next fund. So we often buy shares from the VC in their startups so they can return cash to encourage existing LPs to re-up in the next fund and to attract new LPs. And so if you had invested in our FoF, our fund of funds, and we were in the final close of many of these VCs, it's quite common that we start returning cash within the first few months of having been in those funds if we're driving a secondary. And if they don't sell to us, we're encouraging them to sell into the next funding round when their startup raises money at an even higher valuation. So it ends up, the expectation with the fund of funds is that there's so many, you're in 20, 40, 50 VC funds. There's so many thousands of startups underneath it that the distributions are much steadier than if you were in just one VC fund with 7 or 25 startups only that they've invested in. So that means the expectation is that from January 1st to March 31st, leading up to the next 25K or 250K or 2.5 million capital call. So we allow our LPs to invest every quarter over 2 years. So whatever that amount is, let's say that someone says, I'll invest 2 million as an LP into the FoF, fund of funds, and I'll do $250,000 at the end of every quarter. And so after 1 year, they've done $1 million. After 2 years, they've done the 2 million. Now, what we hope to see is that after a year or two, between January 1st and March 31st, we are distributing with a wire transfer cash on many different little exits that are coming from the portfolio of all these VCs. And that we might have wired, say, $200,000 to the LP before March 31st when they're obligated to wire $250,000 as their next capital call. So if we wire them 200, they only have to sell or come up with 50K cash on top of the 200 we wired them to meet their next 250 capital call. Then from April 1st to June 30th, we're hoping that things are maturing and maybe we wired them 350K of cash between April 1st and June 30th. And so they have 100,000 of profit and now they wire us 250K back. Then perhaps in Q3, from July 1st on, we might have wired them 750,000 and they only have to wire us 250K. So you hope with fund of funds that they can agree to say, I'll do 2 million a fund, I'll do 250K per quarter. And these distributions year after year are, we wire you, roughly 1x to 3x the money you're investing with us on a more steady flow basis. Typically, the direct VC fund has a typical prospect of, in our case, making a 6x plus return. A lot of venture says 3x if you're in growth and 5x if you're investing earlier, but nothing is guaranteed. One never knows how these things play out. But you expect a higher multiple, but much more lumpy distributions. Like you're waiting for that one fund, that one startup that returns the whole fund. And that could take many years to come in. When you're in an FoF, a fund of funds, there's so many more startups. It's kind of lower risk, but if you happen to hit an NVIDIA and a Facebook and a Google, it's watered down and weighted down by the many other investments that did not perform as well as that one. So you expect a lower multiple, but psychologically, a lot of people say, if every quarter you pay us 250K to 750K, and at the end of the quarter, we only have to wire you 250K, we're going to re-up in every vintage you do. After the 2 years, I'll re-up in your next fund and continue to invest 250K or maybe even more. So that's the basic difference between the direct VC fund and the FoF. A final thought around fees. We charge a 1.5% annual management fee times 10 years for LPs that are below $1 million. And then we charge the 1% annual management fee for VCs that are 1 to 10. And then we charge a 1% management fee only for the first 5 years. So effective management fee of paid-in capital is 5% with 95% dry powder to be invested for the big LPs. It's 10% management fee with 90% dry powder for the smaller ones. And for the very small people that are adding value with network, but their capital doesn't really have much of an impact on the fund, they're paying an effective 15% management fee, which is designed to enable us to break even on what we pay the accountants and all the costs of inviting them to the LP events where they get to meet all the other LPs and the VCs and the startups and our expenses. So we have an incremental expense for each LP. If one LP is in for 100 million compared to someone that's in for 200,000, it all works out, but the effective percentage of dry powder is eclipsed by the big ones compared to the little ones. So even for the guy investing 200K, the total dry powder compared to the percentage of paid in capital that is management fee is actually pretty negligible. So it's pretty close to 95% dry powder, and you're only paying a 5% fee because you're paying 15 on 200K. Someone else is paying 5 on maybe 25 or 100 million. So the effective management fee versus dry powder for an FoF like ours is expected to be about 6% management fee and 95% dry powder to be put to work. And then we pay 100% of those exits go straight through to the LPs without us taking anything until they get 100% of their money back. And then it's a 90-10 split. The layer of management fee and carry that our FoF is charging to our LPs in the FoF, we believe is less than the increase in performance they get by accessing the smaller funds. Historically, and Kauffman Foundation and Cambridge Associates have tracked VC funds for over 20 years. If a VC fund is bigger than 400 million in size, only 10% of them will ever get to a 2x cash on cash distribution for the LPs. That means that there's a 90% chance that you will fail to even make a 2x return after waiting 10 or 12 years. Whereas these smaller funds are delivering much higher returns. It's quite common for us that at the time that we commit to a fund 1, 2, 3, 4, we come in the final close at cost when the fund is already up 2x. So we're outperforming 90% of other VC funds, even on the day that we invest. So that's a different topic about what we call final close arbitrage in more details. In this video, I just wanted to explain this is not a hedge fund where you invest in the hedge fund, someone's getting paid just for owning Microsoft stock on your behalf, and you can redeem and just withdraw your money like out of an ATM. With both the fund of funds and the direct VC funds, It's when the exit happens from IPO, M&A, secondary that the money gets wired. And if it's coming through the FoF, it hits us and we wire it immediately without taking anything until we're in profit. And then it's a 10% layer that we think is more than justified by the increase in performance by getting you into these smaller funds. And we're tracking tens of thousands of VCs. So that's it. Thank you.